Namaste to all. I welcome you all to this another webinar organized by the Accounting Standard Board of the ICI. And thanks to all the participants who have spared their time at this crucial juncture in the mid of the September, I would say. Today is the last date for the advanced tax. And of course, going down the line 15 days, we have got the last dates to do the tax audit. But the topic today, chosen very, very wisely, is regarding our accounting of the for the subsidiaries in the consolidated and the separate financial statements of the parent entity. Lot of issues, lot of points would be there, and for that we have got a very eminent panelists out here. We've got our C. Aanchal Jainji, who is a regular faculty for the Ind AS course and who's got more than 15 years of experience. I welcome C. Aanchal Jainji out here. Also with us on this panel for another time is our CA Paras Chadraji, who's got more than a decade's experience in the Ind AS and the accounting standards. I welcome Paras Chadraji.
Thank you, sir.
And to moderate these two experts, we have got another expert, I would say, CA Chandni Gupta ji, who is a keen interest and observer for the Ind AS and AS, both accounting standards. He's also a joint author of a few books on the accounting standards and the Ind AS. I'm hoping this session would be quite fruitful and very interesting. And just to tell all the members that all these videos are available, this one as well as the earlier ones, they're all available on the ICI TV. You go to the accounting standards, you'll get that. So over to you, Chandni ji, for the session, and I'm hoping that it would be a great learning session for everyone.
Thank you so much, Chairman sir. Welcome to all the participants. Today's session is, as briefed by Pramod sir, it's a very, very important topic. I think there have been a lot of queries regarding this topic. The accountants, our fellow professionals are struggling to go through all these disclosure requirements and the accounting treatments. I think we all have stuck in, we all have stuck somewhere in these topics. So with our eminent speakers today on the panel, we will start this session with our first question. Paras sir, I would request you to please answer this question for our audience. The first question is that, is it mandatory to prepare consolidated financial statements if the company has a subsidiary? Say only one subsidiary is there, which is even a foreign subsidiary. And also, if you could just discuss the conditions under which the parent entity need not present the consolidated financial statements.
Sure. So first of all, thanks for giving me this opportunity. And regarding your question, first of all, I'll tell you the provisions regarding the consolidation, that yes, every company who has subsidiary, even it is one subsidiary and even it is one foreign subsidiary, as per the provisions of AS 21 and as per the provisions of Ind AS 110, the holding company is required to present the consolidated financial statement. Right. Now, what are the scenarios under which the consolidation is not required? So first of all, I want to tell you the provisions of AS 21. So AS 21 says that if any subsidiary company has been acquired with the intention to sell, then this consolidation is not required, right? The second condition is that if the subsidiary company is operating under severe long-term challenges in which the subsidiary company would not be able to transfer the fund to the holding company, then consolidation is not required. Now let's talk about Ind AS 110. So para 4 of Ind AS 110 says that every company who is holding one or more subsidiaries is required to prepare the consolidated financial statement, except under the following 4 situations. So what are those 4 following situations? So first one is that the holding company is the intermediary holding company, and it has informed the fact to the owners that it is not going to prepare the consolidated financial statements, and none of the owner has raised the objection against this decision of the holding company. This is the first criteria. Second criteria is that this company is not a listed company, means the debt or equity instrument of this company is not being traded in the market. Third condition is that this company is not in the process of being listed, means it is not in the process to get listed its equity or debt instrument. Fourth condition is that the holding company of this intermediary company or the ultimate holding company of this company is preparing the consolidated financial statement as per the provisions of Ind AS 110. And these financial statements means the consolidated financial statements are available for public use. In addition to these four criteria, there are two more exemptions which have been given to the companies. So first one is that investment company is not required to prepare the consolidated financial statement as per the provisions of Ind AS 110. And second condition is that if any entity has been formed to manage the plan assets, means the company is managing the long-term liability, long-term defined benefit liability or defined benefit obligation, and provisions of Ind AS 19 is applicable to this reporting entity, then the reporting entity is not required to prepare the consolidated financial statement. That's it.
Sure. Thank you so much, sir, for answering the question in so much detail. Our next question is regarding again the whether the company is required to consolidate or not. But in this case, we want to know if the entity is a LLP or a partnership. So I would request Achal sir to answer this question. We want to know whether a company is required to consolidate its subsidiary, which is a LLP, or maybe it's a partnership firm.
Thanks, Chandni. And see, just to give you a perspective as around the consolidation, now if you look at the criteria of Ind AS 110, it talks about control. So the moment we say that the control is established as around any entity, be it a company, means it's a body corporate or it's any other entity, then definitely the requirement of consolidation will be applicable in respect of that particular investee. So now in the context of this understanding about the establishment of control, so if we happen to be in a situation wherein we say that the control is established on an entity, whether it's an LLP or it's any other entity, then such an entity will be mandatorily required to be consolidated in the consolidated financial statements.
Right, that's right. So thank you so much, sir, for answering this question. The next question is to Paras sir. By when should the consolidated financial statements be prepared and audited? Like, we want to understand if there is anything different about the consolidated financial statements.
Okay. So first of all, I want to tell you that Section 129, subsection 2 of Companies Act 2013 talks about the separate financial statements. So it says that separate financial statements should be prepared and presented to the presented before the annual general meeting. Okay. Now, Section 129, subsection 3 of Companies Act 2013 talks about the consolidated financial statement, and it says that if any company is holding one or more subsidiary, then this company is required to prepare the consolidated financial statement, and it should be presented in the annual general meeting. So it is evident that for the purpose of presenting the consolidated financial statement in the annual general meeting, it should be audited and prepared before that.
Right. So essentially, not much difference when a company is preparing both the financial statements. They have to be prepared and audited and presented before the AGM.
Correct.
Right. Thank you so much, sir. One more question to you. Whether a parent is required to consolidate a subsidiary which has been acquired with an intent to dispose it off in the near future.
Yes. So as I said, as per the provisions of AS 21, exemption has been given to the parent company if the parent company has acquired any company with the intention to dispose it off, then the consolidation is not required. However, there is no exemption has been given. There is no exemption has been given under Ind AS 110. And as per the provisions of Ind AS 110, if the parent company has acquired any subsidiary company with the intention to sell, then consolidation is required. Now the question arises, how would you make the consolidation? So this subsidiary company is required to be evaluated as per the provisions of Ind AS 105, because you have the intention to sell it, right? So all the assets and liabilities of this company would be measured at fair value less cost to sale. And while preparing the consolidated financial statement, line by line consolidation will not be made in this case. What the parent entity will do, only the assets, whether current or non-current, of this subsidiary company will be disclosed as a single and separate line item in the consolidated financial statement, right? Similarly, all the liabilities of this subsidiary company, whether current or non-current, will be disclosed as a separate and single line item in the consolidated financial statement. Similarly, in the P&L account, line by line consolidation will not be made, and only the profit from the discontinued operation will be disclosed in the consolidated financial statement.
Right. Sure. Thank you so much, sir, for answering this question in detail. Now, coming to understand the differences between Ind AS and Companies Act, because we understand there are certain provisions in Ind AS and Companies Act which are a bit different on the same note, right? So there is a question regarding the presentation of consolidated financial statements, that Ind AS and Companies Act both require to present consolidated financial statements. However, both the regulations criteria for determining the relationship with other entities are different, right? So in that case, which regulation should we follow, and how should we decide the relationship?
Okay. So if you will read Rule 4A of Companies Accounting Rule 2014, it clearly states that every company is required to prepare the consolidated financial statement in case it is holding a subsidiary company in the form which is prescribed under Schedule 3. Means the financial statement will be presented in line with the Schedule 3 requirement. However, the company will also comply the provisions of AS 21 or Ind AS 110, whichever is applicable to the company. So for the purpose of preparation of the financial statement, the provisions of Schedule 3 will apply. But for the purpose of determining whether whether the investor is having control or not over the investee, the provisions of AS 21 and Ind AS 110 will apply.
All right. So basically, to determine the relationship, we have to look at the standard.
Absolutely correct.
Right. Thank you so much, sir. Next question to you, Achal sir. So now we want to understand more on the concept of control as it is defined in Ind AS 110, and is there any difference from the accounting standards, the AS, as we see?
Sure. So I think this happens to be one of the most important aspect as around the consolidation is concerned, and particularly from the perspective of Ind AS. So first of all, if I'll just touch upon the requirements of consolidation under Indian GAAP, and that is about the accounting standards. So there is a general understanding under Indian GAAP, and that is to say that the consolidation requirements arises when there is a control, and control is something which arises the moment we have majority voting rights. Okay, now which could be in the form of having say control over the composition of board of directors, and which could be through getting more than 50% shares of the investee or a particular company, or in case it's not a company, it's any other entity, then it could be around the majority stake in terms of getting the decision making rights as around the governing body of that corporate entity. So this is something which we understand in the context of Indian GAAP, and the way control has always been evaluated under Indian GAAP. This has been the approach basis which if I have to just quickly summarize this aspect. So under Indian GAAP, the general principle that we follow is the moment we say that the shareholding or the voting rights are more than 50%. Okay, so be it 51%, 52%. So immediately we'll get on to the conclusion that yes, there is a control. Okay, so we'll not get into any other detail to evaluate anything further. So immediately the control gets established, And the moment the control gets established, then definitely the consolidation requirements arise as per the requirements of accounting standards. Now coming to Ind AS, so now we are just completely shifting away from this approach, wherein we are just ignoring altogether this aspect as around percentage shareholding or as around this voting share. Even though these are some of the factors, they do have I would say in terms of assessment of the control, but these are not really the concluding ones, or these are not really the only factors which are required to be looked at when we assess control from Indian GAAP perspective. So under Ind AS, the way control is required to be assessed happens to be through three steps, or you can say there are basically three conditions which are required to be fulfilled. So first, the standard says that the investor should have the power over the investee. Now, this again is a very detailed discussion. I don't think we can get into too much details around it. But if we have to just understand as to what do you really mean by the power, so we can say if the investor has got the power to direct the relevant decisions of the investee, means the final say as around the key activities, as around the key decisions of that investee is something which lies with the investor. That is when the investor happens to be in a position of saying that yes, he has got power over the investee, which again could be through the voting rights, which happens to be there under Indian GAAP, and which could be there through the say having a majority composition of the board of directors, or which would also be through a contractual arrangement, which would also be through some other arrangements. And at times we may also be in a situation wherein the percentage shareholding happens to be less than 50%, but because the power is established and there are other conditions also which we are going to discuss get established, still the control may exist. Okay, so this is first aspect which is required to be considered, and that is the power over the investing. Then comes the second aspect, and that is about the understanding of whether the investor has got the exposure or the rights towards the variable returns of the investee. Now, these variable returns could be anything. Okay, so these variable returns could be the profits, could be the losses. Yeah, so now this is something which needs to be evaluated as around the particular entity which is involved. But the important fact to understand here is that whether the investor gets impacted through the exposure to the variable returns of the investee or not. Now, something which is variable needs to be again assessed on a case-to-case basis. Then the third condition is about marrying these two, okay, wherein we say that through the power which the investor has got, whether he will be in a position to influence the returns of the investee or not. Okay, in such a manner that the returns are significantly impacted as around that investee. Okay, so if we happen to be in a situation wherein all of these three conditions get fulfilled, that is when we say that under Ind AS the control gets established, and that is when the requirements of consolidation will arise. And when we talk about control, so we are talking about unilateral control. So unilateral control means in such a scenario that entity will be considered to be the subsidiary company on which the consolidation rules will apply. So this is how the things are now required to be evaluated as per the requirements of Ind AS as against Indian GAAP. And I would say this is a significant difference, or in fact, this is the most important difference as around these two gaps.
Right, right. So basically, just to summarize this, I think in accounting standard that we all have been studying from the beginning, the control is defined majorly by holding a majority of the voting rights, right? And whereas in India's regime, I think it has been completely changed, and it's not voting rights that decide. So an entity can control the other entity even though it's not holding the majority of voting rights.
Right.
Right. So we have to carefully look at the definition of control and all the aspects thereof to evaluate whether the control has been established or not. Right. Thank you so much, sir, for answering the question. Next question is regarding the de facto control. So I would request Paras sir to answer this question. We want to understand the applicability of Ind AS 110 to de facto control situations.
Okay. So first of all, I want to tell you that this de facto control situation or this guidance is not available under AS 21. So this is the concept of Ind AS 110. Now, what is de facto control? So as Achal and you said that if an entity even not holding the majority voting rights or the shareholding of the investee, even though it can control the investee. So this situation is called de facto control. Now, what are the indicators which have been suggested by the or which have been given by Ind AS 110? So there are few indicators. So first one is that we need to evaluate the control, we need to evaluate the percentage of voting power which is held by the investor and the percentage of voting power which is held by the other investors as well, and the size and dispersion of the other investors as well. So I'll tell you with the help of one example. So suppose there is company H Limited and there is company S Limited. Now in this scenario, H Limited is holding, let's assume 48% shareholding or the voting power of in the S Limited, right? And the remaining 52% shareholding is held by thousands of people, and none of them is holding more than 1% of the shareholder, right? So in this situation, we can say that the H Limited is controlling S Limited because all the decision rights regarding direct the relevant activity of the subsidiary company lies with H Limited, because there would be remote possibility that all the 52% shareholders will cast their vote against the H Limited because there are thousands of people. So it is high possibility that few people are casting their vote in the favor of H Limited, few people are casting their vote against the H Limited, and few people are not casting even their vote, right? So we can say that H Limited is having control over S Limited. Now second indicator is that potential voting right. So what is potential voting right? Potential voting right needs to be substantive, then we will only consider it while evaluating the control, otherwise we will ignore it. So substantive voting right is the situation in which investor has the ability to control or to exercise the voting right whenever it is required, right? So suppose there is H Limited and there is S Limited. Now in this scenario, H Limited is holding 45% shareholding in the S Limited, and this S Limited has also issued OCD, means optionally convertible debenture, and the convertible debenture rights means the conversion option is available with the H Limited, means whenever H Limited wants to convert these debentures into equity shares, it can do so, and it will get additional 15% voting rights. So in this scenario also we can say that H Limited is controlling S Limited. The third situation could be the rights which is rights arranging or rights arising through the contractual rights with the other parties. So let's assume there is again H Limited and there is S Limited. Now H Limited is holding 49% shareholding in the S Limited, right? And 51% voting rights is held by ABC Limited in the equal shareholding, means A Limited, B Limited and C Limited, they all are holding 17% each voting right in the S Limited. Now let's assume A Limited is facing financial crisis and it has entered into an agreement with H Limited that if you will provide me the fund for running my operation, then I will always cast my vote in your favor. And in that scenario, H Limited, we can say, is holding control over S Limited through indirect control, means the 17% voting rights held by A Limited will also be considered while evaluating the control by H Limited. So these are the factors which have been given by the Ind AS 110, and this is the de facto control situation in which even the holder is not holding majority of the voting power or shareholding, then also he can consolidate the subsidiary company and we can say it is controlling the subsidiary company.
Right. Thank you so much, sir. I think the examples made it very clear that it's not just the majority voting rights, even though the entity has a very little shareholding, but if the other a part of the holding is dispersed in multiple shareholders, then also the control can be established. But
Yes.
obviously there has to be a proper evaluation to
Right.
that. Thank you so much, sir. Moving on to the next question, coming back to you, Achal sir. Can an investor have power if it can make decisions concerning the relevant activities of the investee only upon the occurrence of a contingent event and cannot make such decisions currently?
See, I would say this is a situation wherein we can have both the situations, and both the situations could have this answer of yes. So I'll just first of all touch upon the situation of a concept which is called as protective right.
Mhm.
Now, under Ind AS, when we discussed about control and we discussed about power over the investee, one has to understand that the right which is available with the investor should be the one which is substantive. Okay. And there is another type of right which is considered to be protective. Now, let's try to understand as to what do we mean by this protective right. Now, protective right, we can say, is something which arises or which gives a right to the investor to get into a particular situation wherein he will be involved in certain decision making, or he will be involved in action around certain activities only if some event happens. Say, for example, if you have to just take an example, say a banker has given a loan to a company, and the agreement says that if there is a default, then the banker has the right to get the stake in the company, and the stake could also be towards the control in the company. Now, in this scenario, one needs to understand that is it really the business of the banker to have this stake in the company or to invest in the company? The answer is no. And is it really the intent of the banker and that is to invest in this company? The answer is again no. So now, what is the reason of providing this right? This right is more of protective in nature, which is protecting the right of the banker, so that tomorrow if there's a default, then he can then definitely get onboarded on the company, he can get onto the board of the company, or he could also be involved in certain activities of the company through which the banker is protecting his rights towards the repayment that is having. So this is which is called as a protective right. Now, protective right does not give the investor this power over the investee. Okay, so this is something which is excluded, and this is something which also needs to be looked at from the perspective of any event, if at all that arises. Okay, in which case we should say that the power will not arise. There could also be another scenario. Now, once again, we will not be in a situation to always say that if the power to the investor arises only when a contingent event arises, so that will not be considered to be a situation of control, which again could be a no. Why? Because there are certain entities which could be structured in a way that in respect of those entities, the relevant activities get triggered only upon a certain point of time. Okay, so though now in case of a company, let's try to understand as to what do we mean by relevant activity. Now, relevant activity we can say is about the key activity, or is about the significant activities which have a significant impact on the returns which those entities generate. Now, if we talk about day-to-day activities of a company, whether we talk about day-to-day operations, day-to-day purchase or sales, can we really call them to be the key activities or the relevant activities? The answer will be no. But if we talk about some other activities, which could be around capital budgeting, which could be around some financing, which could be around appointment of KMPs, or which could be around any other activity which significantly impacts the returns of that investee, that is something which is considered to be a relevant activity. Now, there could be certain specified entities which are structured in a way that for the day-to-day operations, the investor is not really involved, and that's why he is not having involvement into the day-to-day operations. But that doesn't mean that the investor doesn't have the power over the relevant activities. Why? Because the moment those relevant activities will be triggered, any decision making on those will be required, which could be contingent upon certain event, then immediately that the investor will get into action, and the decision making right will be available with the investor as around those relevant activities. So in those situations, we will be in a situation to say yes, this investor is having the power over the investee. Yeah.
Right. Thank you so much, sir, for the detailed answer. I think that helps a lot in answering the question. Moving on to the next question to you again, Achal sir. What is the accounting for partial disposal of an investment in a subsidiary, that is, the change in ownership interest while retaining the control?
I would say a very simple accounting is required, because if the control is not diluted, so let's take an example. Say an investor has got 100% shares of a subsidiary, and now he's selling, say, 20% shares of the company. So now he continues to enjoy 80% shares of the company, and I'm assuming that when we talk about 100% of share, 80%. So even though these are not the only factors, so the control continues to be there with the investor. Now, in this situation, this 20% share, which is now diluted, now this will not have any impact on the goodwill, first of all. Okay, so the goodwill which was recognized earlier, that will continue to remain in place. Now, what is going to get generated here is the NCI, the non-controlling interest, which under Indian GAAP we call as minority interest, which was not there earlier. Okay, so now the minority interest or the NCI gets generated. I'm using this terminology. Under Ind AS we'll call it as NCI only, non-controlling interest, and this NCI will have to be recognized in terms of the proportionate share towards the net assets of the subsidiary or the entity. And when we talk about net assets, we are talking about the carrying value of the subsidiaries net assets. Now, this part is something which will get recognized in the form of NCI recognition corresponding to the purchase consideration, which is there as an adjustment, and any resultant impact will go to equity. So there's no impact on the P&L in such a scenario. So this is how this is required to be adjusted.
Right. So basically, since there is no loss of control, so everything remains same except that NCI or the minority interest will be added to the balance sheet. Right. Now, in the otherwise question, if the entity loses the control, then how the accounting will go?
Okay, so I'll tell you. So if the entity loses the control, so the accounting under Ind AS and under AS21 would be the same, except there is one gap difference, which I'll tell you. So first of all, I am telling you the provisions of Ind AS 110, and then I'll let you know the gap difference, right? So when the entity loses the control, it will de-recognize all the assets of the subsidiary company, which this company is holding, at their carrying value, right? It will de-recognize all the liabilities of the subsidiary company at their carrying value. It will de-recognize the NCI portion, which would be again at the carrying value. It will also de-recognize the goodwill, if any existing in the balance sheet, and it will also be at the carrying value. Then it will recognize the bank proceeds, means if any fund has been received for selling this subsidiary company, then the bank proceeds will also be recognized. And the investment or the interest, if any, is held by the investor in the subsidiary company, or you can say the former subsidiary company, then this investment will be recognized at the fair value. Mind you, I am saying here, this investment will be recognized at the fair value in the former subsidiary. Now, this is only the gap difference. If you talk about the provisions of AS21, it says that if any interest or investment is held by the holding company in the former subsidiary, then it will be recognized at the proportionate carrying value. And Ind AS 110 says that this portion will be recognized at the fair value. And obviously, the difference of all these entries will go to the P&L account, because in this scenario, you are losing the control. So what would be the consolidated journal entry in nutshell? So you will debit the bank account, you will debit the NCI, you will debit the liability, you will credit the assets, you will credit the goodwill, and the difference portion, whether it is debit or credit, will go to the profit and loss account.
Right. So, so basically, when the entity loses the control, everything related to the investee will get reversed accordingly, and the people will be impacted.
Correct.
Right. Thank you so much, sir, for answering the question. Coming on to the next question, this is regarding when the investee and the investor are having different reporting periods. So we want to understand how do they prepare consolidated financial statements when the parent and the subsidiary do not have the same reporting period, and also how the assets and liabilities will be classified into current and non-current in case they have different reporting dates.
Right, very interesting question, and I want to devote few minutes here.
Sure.
Right. So if the entity means the parent company and the subsidiary company does not have the same reporting period, then the subsidiary company is required to provide the additional information. Right. This is scenario one. So first of all, rather I should say the reporting period of the subsidiary company and holding company should be same. If it is not same, then the gap between these two reporting period cannot be more than 3 months as per the provisions of Ind AS 110, and it cannot be more than by 6 months as per the provisions of AS 21. Right. So for the purpose of preparing the consolidated financial statement, the subsidiary company will provide the additional information. Now, this additional information could be in the form of unaudited trial balance. It could be in the form of MIS report. It could be in the form of group reporting package, or it could be in any other form. Right. If the subsidiary company is not able to provide this additional information, then the subsidiary company will provide the significant transaction which has taken place during this intervening period. Right. So this is the requirement. Now comes to the presentation of current and non-current classification. So let's assume there is one holding company which is S Limited and H Limited, and there is one subsidiary company which is S Limited. Right, this holding company is following Ind AS and this subsidiary company is following IFRS. So this holding company is preparing its consolidated financial statement for the period ended, let's assume 31st March 2023. And the subsidiary company follows the calendar year as a financial year. So it is prepare its standalone financial statement for the period ended 31st December 2022. Now let's assume there is a loan in the standalone financial statement of the subsidiary company, and the due date of this loan is, let's assume, 28th February 2023. Right. So this subsidiary company has disclosed this loan as a non-current liability because it is falling due after 12 months. Now, while preparing the consolidated financial statement, provisions of Ind AS and Ind AS 110 and AS 21 says that the presentation of current and non-current will be made as per the financial statements of the group or the holding company. So the holding company is following the 31st March 2023 as a financial year, and hence this loan will be classified as current in the consolidated financial statement because it will be repaid till 28 February 2023. Right. Now I want to discuss few complex case studies here, so which I have observed practically when I was preparing the consolidated financial statement. So let's assume there is company H Limited, which is holding company and which is following Ind AS, and there is company S Limited, which is subsidiary company, which is following IFRS. Now what is the case? This subsidiary company has taken a long-term borrowing for a period of 10 years, let's assume. And it is mentioned in the loan agreement that if the subsidiary company defaults any terms and condition of this loan agreement, then the loan would become repayable on demand. And let's assume this subsidiary company has defaulted any terms and condition of the loan agreement, right? And this loan now, and further, this subsidiary company after the reporting date, but before the approval of the financial statement, has rectified this loan. But the provision of IFRS, or you can say IAS 1, says that even if such loan has been, such default has been rectified by the subsidiary company after the reporting date, but before the approval of the financial statement, and even lender has agreed not to demand the loan, then also this subsidiary company will disclose such loan as current because it has defaulted the terms and conditions. Now come to the provisions of Ind AS 1. It says that if the subsidiary company has rectified the loan, and after this subsidiary company has rectified the default after the reporting date, but before the approval of the financial statement, and lender has agreed not to demand the loan, then in this scenario, this loan would be still classified as non-current, because we are preparing the consolidated financial statement as per the provisions of Ind AS 110 and not as per the provisions of IFRS 9. So this loan would still be classified as non-current. Right. Now, second scenario, there is company H Limited, which is holding company, and there is company S Limited, which is subsidiary company. Now, both the companies are following Ind AS, right? So what is the scenario? In this case, holding company has taken a loan from the market and it is paying interest cost against this loan, right? And the fund which have been received through this loan has been invested in the subsidiary company. Subsidiary company is S Limited, let's assume. Now, in the separate financial statement of this holding company, loan is existing, interest cost is existing, and investment is existing. Now come to the financial statement of subsidiary company. The subsidiary company has issued equity share capital because the holding company is showing this loan as investment in the subsidiary company. So it has issued the equity share capital. Now this subsidiary company is constructing a qualifying assets. Let's assume this company is constructing a building, right? And building takes substantial period of time to get ready for its intended use. So the provisions of AS 16 or Ind AS 23 says that if any company has taken a loan regarding the construction of a qualifying asset, then the interest cost which has been incurred by the entity would be eligible to capitalize to the cost of the building, right? Now, what is the scenario? In the separate financial statement of subsidiary company, qualifying asset is existing, and in the separate financial statement of the holding company, loan is existing and the interest cost is existing. Now we are required to prepare the consolidated financial statement. So as per the provisions, or if you will see as per the group's perspective, this loan is existing in the consolidated financial statement, this interest cost is existing in the P&L account of the group, and this qualifying asset is also existing in the group balance sheet, right? So the interest cost which has been charged to the P&L account of the holding company now would be eligible to capitalize to the cost of qualifying asset. This is the scenario which has been given under Ind AS 110, right? Now talk about AS 21. So as per the provisions of AS 21, two schools of thoughts are available. First school of thought says that yes, this interest cost can be capitalized because from group's perspective, loan is existing in the consolidated financial statement, interest cost is existing in the financial statement, consolidated financial statement, and the qualifying asset is also existing in the consolidated financial statement. The second school of thought says that no, you cannot capitalize this interest cost because the loan has been acquired by the holding company and the construction is being made by the subsidiary company, right? So this interest cost cannot be capitalized. So now why there are difference between as per the provisions of Ind AS 110 and AS 21. So if you will read para number 11 of Ind AS 23 and para number 9 of AS 16, which talks about the borrowing cost, the word group is missing. So therefore, as per the provisions of Ind AS 110, you can capitalize the cost, and as per the provisions of AS 21, two school of thoughts are available. First one says you can capitalize this cost, and second one says you cannot capitalize this cost, right? Third scenario, there could be possibility that holding company is India, which is following Ind AS, and subsidiary company is in foreign, which is following IFRS. Now there is investment property in the books of subsidiary companies. So investment property is allowed to be valued at fair value as per the provisions of IFRS, but it is not allowed as per the provisions of Ind AS 40. So while preparing the consolidated financial statement, this investment property is required to be valued at cost. So what message I want to pass that it is not as simple as it looks like, that consolidation is so simple, line by line consolidation is required. No, this is not the scenario. You will have to consider all the provisions of Ind AS and the gap difference, and or you can say carve out and carve in provisions between the Ind AS and IFRS. That's it.
Right. Thank you so much, sir, for answering that question. Moving on to the next question, Achal sir, to you, how to account for the acquisition-related cost incurred at the time at the time of investments in subsidiary?
Sure. So as regards the acquisition related costs, so I would say these are the costs which could be related to the legal fees or the professional fees or some administrative activities in respect of which some costs are incurred at the time when the subsidiary is acquired. And when we say that the subsidiary is acquired, we are basically talking about the control here. Means we are getting the control in the subsidiary. So now, as per the requirements of Ind AS 103, any such acquisition related costs are required to be charged off. I mean, they will be charged to P&L straight away. Okay, so this is something in very simple terms we can say is the treatment of acquisition related cost. However, if there are any costs which are towards the issuance of debt or which are towards the issuance of equity, those are required to be dealt as per the requirements of financial instruments, that is about Ind AS 109. So just briefly touching upon them, when we talk about any of the costs as around the issuance of debt, so that is something which will form part of the amortized cost requirements as per Ind AS 109. And when we talk about any of the costs which are towards the equity, so they get adjusted with the equity as per the requirements of Ind AS 32. But that is something which is a different perspective altogether. But if we just talk about acquisition related costs, we just need to simply remember that this will go to P&L straight away.
Right. Thank you so much, sir. So our next question is regarding the employee stock options. Sorry, my bad. I think we have missed the question. The other question is regarding the goodwill and bargain purchase. So this question is to you, Paras sir. What does the goodwill and bargain purchase represent in a business combination, and what is really the treatment of these two, and how it is different in Ind AS and AS regime?
Okay, so goodwill is a situation in which you have, let's say, you can say that goodwill is a situation in which the investor has paid more consideration in respect of the net assets acquired, right? So suppose you have acquired the net assets of 80 rupees and you have paid the consideration of 100 rupees. So 20 rupees will be the goodwill. So this goodwill is generally paid regarding the reputation or the brand value of the business which you have acquired. On the vice versa, if you have acquired net assets of, let's assume, 100 rupees and you have paid only 80 rupees. So in this scenario, the capital reserve, or you can say the bargain purchase, will arise. So it is the scenario where you can say that you have got a good deal, right? Therefore, you have paid less amount in comparison to the net assets acquired. Now, what are the disclosure requirement or how this will be presented as per the provisions of AS 21? So goodwill will be disclosed separately in the balance sheet, right? And it will be amortized over a period of 5 years or its useful life, whichever is lower. Now the bargain purchase, or you can say the capital reserve will be disclosed under the reserve and surplus as a separate line item. Now come to the provisions of Ind AS 21. Oh, sorry, Ind AS 110. So Ind AS 110 says that goodwill will be disclosed separately, but it will not be amortized. It will be tested for impairment annually, right? And the bargain purchase, that if there are sufficient evidence available with the company that yes, it has got a good deal, and there are sufficient evidence that yes, it has a gain of 20 rupees, then it will be presented through OCI. It will be presented in OCI, and then it will be ultimately go to the capital reserve account. But if the sufficient evidence is not available with the holding company, then it will be straightforward charged to the capital reserve account. So the ultimate treatment of this bargain purchase is the capital reserve. Now, if the sufficient evidence is available, it will be routed through OCI. If the sufficient evidence is not available, it will be directly charged to the capital reserve.
Right. Thank you so much, sir, for answering that question. Coming to the next question, which is to Achal, sir. This is regarding the employee stock options and how, what is the treatment of employee stock options in case of consolidation, wherein the options given by the investor are yet to be vested?
All right, so I think it seems to be in the context of control assessment once again, and therein we can just understand one concept, and that is about the potential voting right as far as the control assessment requirement is concerned from the investor's perspective. Now, what are potential voting rights? Potential voting rights, we can say, are those rights which have the potential of becoming a voting right, or which have the potential of sort of assigning the substantive right to the investor. Okay, now in the context of these ESOPs, wherein we mention that these are yet to be vested, so till the time these are not vested, so definitely these are not exercisable on the part of the investor. And because these are not exercisable, that's why they do not give the substantive right to the investor. And that too, which is something which is not currently exercisable, which is what Ind AS 110 requires. So it says that the right is something which should also be currently exercisable. Currently means it should be exercisable at the time when the decision around the relevant activity is required to be made. Okay, so now because these are yet to be vested, so that's why I would say this will not have any impact on the control assessment, or we can say just that as far as the control assessment is concerned, this will not provide control to the investor from the consolidation perspective.
Right. Um, I think that is very clear regarding the employee stock options in the context of how the control would be impacted. Right. Coming to the next question to Paras sir. So this is a bit elaborative question. Suppose entity A has 4 wholly owned subsidiaries that hold 25% equity shares each in entity Z. Now,
Okay.
entity A has no direct shareholding in entity Z.
Okay.
So, how should entity Z be consolidated by entity A? That is, whether by applying equity accounting by the intermediary subsidiaries and then consolidation by entity A, or direct consolidation by entity
So the consolidation will be made directly, because if you will apply the equity accounting, so equity accounting says that you are required to consider, or you are required to pick up only to the extent of your shareholding the profit of the subsidiary or the associate company,
A?
right? So in case of subsidiary, line by line consolidation is required. Equity method cannot be applied. In case of associate company, equity method will be applied, and then all the assets and liabilities of the associate company will not be consolidated, right? But since A Limited is holding control over Z Limited through its intermediary subsidiary company, and hence line by line consolidation is required in this case. Otherwise, the assets and liabilities of the Z will not be able to be captured by A Limited. So direct consolidation is required, means line by line consolidation is required instead of applying equity accounting.
Right, right. Understood that answer. Thank you so much, Paras sir, for your kind answer. Next question, whether a company is required to disclose the fact that the financial statements prepared by them are separate financial statements. So this question is to you, Achal sir.
All right, so now as around the disclosure requirement, I would say first of all, let's discuss about this separate financial statements, because I see a lot of confusion as around this term. See, there's a common terminology around the financial statements that we use that happens to be standalone financial statements. Now, what is standalone financial statements? Wherein the financial statements of that entity are prepared and presented, means that entity itself, and which we can say is different from the one which is consolidated. Okay, different from the consolidated financial statements. Now, I would say there are three terminologies which we can understand. First is about the separate financial statements. Now, an entity which has got a subsidiary, associate, or a joint venture, in which case consolidation is required, or in which case consolidated financial statements are required to be prepared, if that entity prepares its own financial statements. That is what is called as separate financial statements. Okay, so now this is the meaning of separate financial statements. Then there is another term, and that is individual financial statements. Now, this is something which arises in case of an entity which does not have any of these sort of entities, means neither do they have this subsidiary or associate or joint venture for which the consolidation is required. So this entity therefore will only prepare its financial statements, means its own financial statements, and will therefore be called as individual financial statements. Okay, and third, of course, is about the consolidated financial statements, wherein we consolidate any of these entities as we just discussed. So now coming to the aspect of this separate financial statements. Now, separate financial statement is something which is in the context of standalone financial statements. Now, why would this happen? This would happen more so in a case when the company is preparing its financial statements, means its own financial statements, and may not be preparing its consolidated financial statements. Why? Because there's an exemption available, which has been discussed uh, initially during the course of our discussions. Now, therefore, it becomes important for such a company to give a disclosure that this company has elected not to prepare the CFS or the consolidated financial statements and is preparing only the separate financial statements. And in those separate financial statements, such a company will also give some more disclosures. Let's try to understand what are those disclosures. One, that the financial statements which are being prepared are separate financial statements, of course, which is the fact part, factual pattern as around the financial statements are concerned. Second is about the election of that exemption, means it has chosen to avail that exemption basis which the consolidation has not been done. Third, of course, will be around the name or the principal place of the business of the entity whose consolidated financial statements are prepared. Now, whenever this exemption is available, so now why is this exemption available? Because either the holding company of this investor or the ultimate holding company, means the intermediate holding company or the ultimate holding company, could be preparing the consolidated financial statement. So a disclosure around that is required to be given, wherein the address where those kind of consolidated financial statements are obtainable, that is also required to be specified. Further, some more disclosure should also be provided, which is towards the list of significant investments in the subsidiaries, joint ventures, associates, which will include the names of those investees, means names of those entities, principal place of their businesses, then of course the proportion of the ownership interest which is held in those investees, and then the method which is used to account for those investments, means towards those subsidiaries, joint ventures, or the associates. Now, this is in respect of the separate financial statements, wherein we talk about an entity availing the exemption. Now, this exemption could also be available to a type of entity which is called as investment entity, okay, which again may have chosen to prepare the separate financial statements, or to which the separate financial statements are the one which are applicable. Now, if at all this entity prepares its separate financial statements, such an entity will also be required to disclose this fact in its financial statements, and there again it will have to give certain disclosure requirements which are there as per Ind AS 112, which could be in respect of its investments in various investees which this entity may be having.
Right. And also, we want to understand if the company is required or is not required to prepare the consolidated financial statements, as the case may be, if it elects or not elects to. What are the disclosures which are required in the separate financial statements as per Schedule 3? If there is any additional disclosure which is required, or is there anything different from the standard?
So I think
Yeah.
So I think Achal has not left anything in place
Right.
to say, because he has covered separate financial statement disclosure and he has also covered consolidated financial statement disclosure. So Schedule 3 but obviously says that duplicacy of disclosure should not be there. So suppose in the separate financial statement, let's assume CIF value of purchase is being given or the FOB value of sale is given. So these disclosures are not required in the consolidated financial statements, right? So I think all the disclosures have been explained by the Achal.
Right. Thank you so much, sir. So before we move on to next question, I would like to take up some live questions which have come. So mostly
Sure.
we have already answered these questions, but I think answering to these questions directly would help summarize the entire session so far. Right. So the first question is, one company has 50% shareholding in another company. Will it be regarded as subsidiary? Is consolidated financial statement applicable? So I think we have already covered this in during the session. But I think just to summarize or to revise the session, we can probably just
Okay.
answer.
So provisions of AS 21, if you will see it, these provisions are rule based, means specific parameters have been given under AS 21, which says that if the majority of shareholding is held by the investor or the majority of voting power is held by the investor, then the control is there. Otherwise, the control is not there. Now come to the provisions of Ind AS 110. So if you will see the definition or the evaluation of control which has been prescribed under Ind AS 110, it is principle based, means judgment is required. So I gave you the example of holding company of Fetch Limited, in which it is holding 48% shareholding, and even though it is holding the control over the investee. So whether 50% gives the control or not, this could not be explained, or this cannot be means answered straightforward. Then yes, it is holding control or it is not holding control. So additional factors which we discussed in de facto control situation needs to be analyzed, means whether the company is having or whether the investor is having potential voting rights or not there, whether the investor is having additional contract with the investee or some other parties who can influence the decision or who can influence the relevant activity of the subsidiary or not. So the provisions are principle based, and judgment is required and indicator is required to be evaluated whether the control would be there or not in 50% voting right.
Right. Thank you so much, sir, for summarizing the concept again for our audience. Next question we have received from audience is, subsidiary company incorporated, but share capital money not sent pending ODI by parent company. Can we leave the consolidation as practically there is no control? So between you and Achal sir, whoever wants to take this.
Yeah, sure. So, see, the moment you use this term subsidiary company, I would assume that the control is there. Okay. Uh, because the facts are limited. So, I'm just assuming that to be in place. And the moment we say that the subsidiary company is in place, so definitely because the control is there, so the consolidation is required. Now, there could be certain transactions with this subsidiary company, which could be around the application money or some part, which could be around, uh, increasing the capital or decreasing the capital, which could be the perspective which he might be trying to understand, which is not very clear. But as far as the understanding goes, I would just request you to keep it very, very simple. The moment we go to Ind AS, we need to just simply understand that whether the control is established or not, and which arises through fulfillment of three conditions: power over the investee, exposure to variable returns, and the ability of the investor to influence those returns or not. The moment we have these three in place, control gets established, and the moment control gets established, such an entity will have to be consolidated. Okay.
Right. So, irrespective the capital money has been sent or not, I think it's important that you understand whether the control has been established or not. Right. At the transaction level, because obviously we have very limited information here. At transaction level, whatever happens, we can, I mean, the assessment can be done separately. But as Achal sir has mentioned, As far as the consolidation is concerned, it is solely depending upon the establishment of control if the Ind AS is applicable.
Correct. And just to add to this, see, the moment you say that the subsidiary is there and the control is there, it may happen that the investor is just trying to infuse more capital there, okay, which has not been infused as yet. Okay, so let's suppose we are just starting off with an initial capital of 1 lakh or 10 lakh or 50 lakh, whatever it is, and the intent is to then infuse more capital in this. Now, because he has not infused more capital, does not take away this establishment of control if it is already in place. Okay, but there could also be a perspective around it that if let's suppose this business is getting acquired, okay, wherein the consideration is not yet passed on, which needs to be evaluated from the perspective of Ind AS 103, that whether this business is acquired or not, where again we need to establish the existence of unilateral control. And I'm again assuming that control is established. Huh? So this should not really confuse us. See, till the time we are in Ind AS, all of these factors will not bother us because Ind AS doesn't require us to just only focus on the share capital or the shareholding or the voting right the way it used to happen under Indian GAAP. So I would say under Ind AS, things have become slightly simpler as far as these aspects are concerned.
Right, absolutely. Thank you so much, sir. I think on the same lines, there is a question by one of the participants that can two or more conditions be combined together to check power to check the power of control under Ind AS. So I think out of those three conditions which I think you mentioned regarding the control, so they're confused if two or more conditions are sufficient.
Sure. So see, it's not about combining the condition. One has to understand that all these three conditions have to be fulfilled. Okay. So if we say that only two conditions are fulfilled and the third one is not fulfilled, then of course control cannot be established. But generally, if you look at the things practically, the moment we say first two conditions are established, generally you will find that the third condition is already fulfilled. I'm just saying generally, except for in those exceptional circumstances.
Mhm. Right, absolutely. Thank you so much, sir. I think there is one more question. Um, how does Ind AS 110 impact the assessment of goodwill and the recognition of non-controlling interests at the acquisition date? And how does Ind AS 110 address situations where there are potential voting control but not necessarily control in substance? So I think the second part has already been answered, that it is not the control under Ind AS regime is not judged by the voting rights. It is the control in substance actually, right? The conditions that Achal sir has already reiterated multiple times, so I think that answers the second part. The first leg is, how does Ind AS 110 impact the assessment of goodwill and the recognition of non-controlling interest at the acquisition date?
Sure. So let us just try to understand this point because I think we need to break it into two stages. See, when we talk about acquisition of business, so in case of acquisition of business, Ind AS 103 comes into the picture on the date of acquisition. And if the business is getting acquired and on that business, the investor is getting control, means unilateral control. So that is when we will say that the criteria of 103 is fulfilled and the acquisition accounting will be followed on the date of acquisition. So let's suppose today we are on 15 September. So 15 September, a business gets acquired. Okay, that is the day when the acquisition accounting will be done, but that will not be done as per Ind AS 110. That will be done as per Ind AS 103. At which point of time purchase price allocation exercise will be carried out, which is in simple terms we can say is all about computation of goodwill. Okay, and in very simple terms, if I have to keep it like this. Okay, so now on 15 September, we have business in place wherein the goodwill is identified, wherein the NCI, if at all NCI is there, that also gets recognized. Okay, but from this very day, we will start consolidating this business. Why? Because now the control is established. Okay, so now starting from 15th September, after the application of 103, the application of Ind AS 110 will start. and which will go on towards the reporting date. Okay, so that means if we move on to 31st March 2024, this business will get consolidated, in which case this will be consolidated using the principles or using the requirements which are there as per Ind AS 110. Okay, so this is something which we need to understand, that first of all we'll apply 103 and then we move on to Ind AS 110. So Ind AS 110 is not really impacting the goodwill or the NCI, because on this very day when the business is getting acquired, 103 is getting applied. So subsequently this will be taken care of by Ind AS 110.
I have
So that is how
something
one needs
to
to look at it.
I have something to add here.
Sure.
So as per the provisions of Ind AS 103, two methods are allowed. You can go for fair value method and you can go for pooling interest method if the acquisition is going to be held within the group, right? So under pooling interest method, you are required to make the consolidated balance sheet on the date of acquisition of control by using the carrying value of the business, right? And in this scenario, goodwill never be erased. Always the difference will go to the capital reserve, right? If you have acquired the business outside the group, then you will use the fair value method. And whenever you are using the fair value method, goodwill might be erased, right? Means there can be bargain purchase gain and there can be goodwill as well. So by this way, your goodwill can be impacted. Right, now comes to the NCI portion. So there are two methods available under Ind AS 103, which talks about the calculation of NCI. First one is fair value method. So means you can recognize the NCI by using the fair value method. And second one is the proportionate value method. So you can also recognize your NCI by using the proportionate value method, right? So by this way, your goodwill and NCI can be impacted. And one more thing which I want to highlight, if you are using the fair value method, means you have acquired the business outside the group, there will always be difference between the tax base and book base. And in this scenario, you are also required to consider the provisions of Ind AS 12, which is deferred tax.
Right. Thank you so much, sir, for such detailed answer. I hope the participant must have gotten the answer as they were seeking. In case something has been left out, maybe you can again post the question in the live chat and we can take up the question. Thank you so much, sir. Coming back to the discussion we were having, now we want to understand more on the investment entities part, right? So this question, I would request Achal sir to answer the question. Basically we just seek some guidance about the investment entities as is given under the standards.
So investment entity, we can say, is an entity which fulfills certain criteria. One, generally we'll see which has got one or more than one investor who are investing in this entity, means who are infusing funds in this entity primarily for the purpose of primarily which is running its business of investment management services. Second aspect or the second criteria which you get to see is around the business purpose of this investment entity. Now, the commitment from this investment entity towards its investors would be that this entity would be involved in the usage of the funds which it has received from the investors, through which it will generate two sort of income. Either it will be capital appreciation or it will be the investment income, or it could be a combination of these two, but it will be limited to only these two types of income. And third, and which is again a very, very important aspect, and that is about the measurement criteria. See, the way this investment entity will want to measure and evaluate the performance of various investments that it will have will be through the fair value mechanism as against any other mechanism. Yeah. So the moment we have, you sort of these three conditions fulfilled, we will say that such an entity happens to be a kind of investment entity, which has got some characteristics like generally it will have more than one investor, though it could also be a scenario wherein it will have only one investor, but generally you will find more than one investor. Then generally you'll see that this entity is not limited to making an investment in one entity. This entity will be making investments in multiple entities. And third aspect is again around the income or the type of income which is committed to be generated, which is limited to that sort of income, and again the fair valuation mechanism which this entity uses.
Thank you so much, sir. About the investment entity only, whether these entities required to measure its investment in subsidiaries at FVTPL, which is fair value through profit or loss, in its separate financial statements.
Yes. So in fact, an investment entity does not consolidate its subsidiary. It only measures the subsidiary at fair value in its separate financial statements. However, there's one exception to this. If the subsidiary of this investment entity happens to be an entity which is not an investment entity, okay, and which is not in itself an investment entity, and which is involved in investment management services, and the activities of such an investee are sort of related to the activities of the investment company, means the investor, which happens to be the investment company in this case, such type of subsidiary will be consolidated. Okay. Yeah, so this happens to be an exception wherein the subsidiary gets consolidated, and which type of subsidiary gets consolidated. Otherwise, the subsidiary will be measured at fair value, because that is primarily the mechanism which it follows, and that is the underlying basis through which this entity is considered to be an investment entity.
Right. I think that clarifies both aspects, whether the how the consolidation will happen and the cases in which consolidation will not happen. Thank you so much, sir, for answering that question. Um, Coming to the next question, which is regarding the consolidation process of trust created by company or the partnership firm, where company is holding 90% of the profit sharing, and in this case the AS is applicable, not the Ind AS.
Okay, so I think we are looking at it from the perspective of Indian GAAP only, wherein we are talking about some sort of entities which are not really the body corporate, but wherein we are saying that the percentage uh, uh, or the stake in those entities happens to be 90%. Okay, so I would say that such entities should also be consolidated. Why? Because if you look at the criteria of control under Indian GAAP, so it says that if we have the majority voting right, or if we have the majority power in respect of the governing body, or in respect of the stakes which are involved, which happens to be very, very clearly established in this case. So that's why such entities should also be consolidated even under Indian GAAP.
Thank you so much, sir. I think that helps. Before moving on to the next question, we have another question from the live telecast. I think again this we have already covered, but I think just to brief and or maybe consolidate and summarize the answer for participant, please give reference of AS or Companies Act allowing exemption of not to consolidate the accounts and disclose basic details of subsidiary. So what I understand is they're asking if they have the company has a subsidiary, but they want to avail the exemption. So what exemptions are available in which standard, or maybe in the Companies Act, and what basic disclosures can be given?
Okay, so in case of Ind AS 110, there is para 4, which talks about the exemption given to the parent company for not preparing the consolidated financial statement, right? Under Companies Act, there is no exemption given to the parent company regarding the preparation of the consolidated financial statement. If we talk about AS 21, so there is exemption, which I discussed earlier, that if the subsidiary company has been acquired with the intention to sell, so the company is not required to prepare the consolidated financial statement. But I don't remember the exact para number of AS 21.
Mm-hmm. Right. So I hope that answers the question. In case you have any further question, I request participants to again post in the live chat. Now, I think coming to the disclosures, I think anything that starts in the standards ends with the disclosures. So we have two questions regarding the disclosures. I request Achal sir to answer the question. What are the disclosure requirements in relation to significant judgments and assumptions as contained in Ind AS 112?
Okay, so now let us try to understand as to the areas where the significant judgment and assumptions are involved, because I would say disclosure is one area which is generally not really focused upon by most of the professionals, whether we talk about it from the management perspective or from the auditor's perspective. So that's why I'm just trying to build up as to how these disclosures are required to be really looked at. See, as far as the disclosures under Ind AS 112 are concerned, these are more towards the consolidation requirements, and judgments and assumptions are required particularly in respect of control. You remember if we the discussion that we had around control. Now,
Right,
control assessment is something which is not easy. It
right,
requires a lot of judgment, a lot of assumptions, and the fact pattern needs to be evaluated very, very carefully. Basis which we are in a position to say that yes, whether the unilateral control exists or not. When I talk about unilateral control, I'm talking about a situation wherein the investee will become a subsidiary company. Then there could also be a situation wherein the control is there, but the control happens to be a joint control rather than unilateral control, means the control is sort of shared by one or more investors. Okay, so that happens to be a situation which is considered to be a joint control, where again same sort of judgments, assumptions are required to be considered, applied. And the third situation could be the one wherein the entity or the investee happens to be an associate, wherein it is required to be evaluated that if the control is not there, neither unilateral nor joint control, then whether the significant influence exists over that entity or not. So if we talk about all of these situations, unilateral control, joint control, or the significant influence, all of these are very, very judgmental. Okay, so that's why the disclosure requirements as around the judgments which have been taken are required to be given in the financial statement. So what will the entity do? Entity will talk about the significant judgment assumptions which are taken by the entity in respect of this control assessment, or whether it is in respect of joint control assessment. Then under joint control, again, there could be type of the joint control it is, means the entity could be a joint operation or it could be a joint venture, depending on the structure of the entity which is in place. Then there could also be certain disclosures which are around judgments or the assumptions which are made in determining that the entity does not control another entity, even though it holds more than half of the voting rights. The case scenario that we have discussed, that this
right,
percentage shareholding is not the only criteria. That the entity controls another entity even though it holds less than half. Okay, so it could be a situation wherein more than 50% is held, but the control is not there. Less than 50% is held, but the control is there. Or it could be a situation of a principal or agent, which again has been discussed under Ind AS 110 as around the control criteria. Or it could be towards a situation wherein the significant influence has been established, which is presumed to be in place the moment we have 20% voting right, though it is not necessary that would always be available or this will always be applicable. So whenever we do this assessment, standard requires disclosure of all of these aspects to be given in the financial statements.
right. I think very rightly mentioned, sir. I think this is the fundamental difference also between AS and Ind AS, that Ind AS require extensive disclosures, because to all the participants, you see, when we talk about Ind AS 112, it is not a standard which gives any recognition or measurement criterias or guidance, but it is a standard which solely focuses on the disclosure, right? So in the Ind AS regime, there are extensive disclosures which are required, and there are dedicated standards which only talk about disclosures, whereas it was not the case in AS regime, right? So And also the another fundamental difference was that Ind AS is more principle based. So as Achal sir mentioned, that since now the control definition has been changed completely, which requires a lot of judgment by the management, a lot of assessment of whether the control is actually established or not, even though the company may or may not hold majority voting rights, right? So I think very clearly mentioned by sir and explained in a very detailed manner that significant judgments which have been taken by the management, the assumptions that have been taken into consideration need to be disclosed properly as per the Ind AS 112, because the control that has been established would require a lot of assessment, a lot of evaluation of the facts, which will differ from case to case, right? So thank you so much, sir, for the detailed answer. Moving on to the next question, uh, I would request Paras sir to answer this question for us. Under which circumstance summarized financial information for subsidiaries are required under Ind AS 112, and under what conditions such disclosure is not required?
Okay, so there is only two conditions. So first one is that if the company or the parent company is holding NCI, then in that situation, dividend paid to this NCI is required to be disclosed, and the summarized information of this subsidiary company is required, like assets of the subsidiary company, liabilities, profit or loss, cash flow of this entity. Under situation where the subsidiary company has been acquired with the intention to sell, no disclosure is required. Why? Because provisions of Ind AS 105 will be applicable in this case, and hence no disclosure is required.
Right. Thank you so much, sir. So now moving on, coming back to the live questions, uh, there is some question regarding the major carve outs or carve ins versus IFRS regarding the consolidated financial statement. So if we have any carve outs, carve ins, or any
Yes.
differences, then maybe if you could brief for
So
us.
you are talking about only consolidation standard, right?
Right.
So there is only one carve out between Ind AS and IFRS, which I have already explained through my case study, that if the subsidiary company is having investment property, so as per the provisions of IAS 40, investment property can be valued at fair value, right? And as per the provisions of Ind AS 110, investment property can't be valued at fair value. It will have to be on a mandatory basis to be valued at cost. So this is only the carve out which is available regarding Ind AS 110 and IFRS 10.
Right. So I think that was already discussed, but yes, thank you so much for reiterating that. I think we have already discussed various differences versus AS, because in India, as we speak, India is AS, both the gaps are running hand in hand, not hand in hand, in fact. There are various and major differences, but we would also, it would be helpful if we get a summarized version of differences between AS and Ind AS with respect to consolidated financial statements. Like, what are the major differences which our professionals can probably follow if the companies are in AS or in Ind AS?
Yes, so there are lots of differences, but if you talk about the major differences, so I can tell you. So first one is the definition of the control, right? So which has explained by the Achal in detail that three conditions would be satisfied. First one is power should be there, and the control over the relevant activities should be there, right? But if you will see the provisions of AS 21, it has given the two parameters that only the you can have the majority of the voting power or you can have the majority of the shareholding. Then only control is there. Otherwise, control would not be there. So this is the one difference. The second difference is regarding the potential voting rights. So potential voting rights are not considered while evaluating the control as per the provisions of AS 21. But these potential rights are considered as per the provisions of Ind AS 110 if there is chances to be substantive of this potential voting right. Now, third difference is that, as I told you, the difference between the two reporting period means the reporting period of holding company and subsidiary company cannot be more than by 3 months in case of provisions of Ind AS 110, and it cannot be more than by 6 months in case of provision of AS 21. Right. Now, another difference is that as per the provisions of Ind AS 110, NCI can be negative. But if you talk about the AS 21, it says that minority interest balance cannot be negative. It can be restricted up to 0. Right. So this control means this is one of the major difference, that the NCI portion can be negative in case of Ind AS 110, but in case of AS 21, it cannot be negative. Now, last difference is that in case of intra-group transaction, under AS 21, deferred tax is not required to be created in case of elimination of intra-group transaction, but as per the provisions of Ind AS 110, deferred tax is also required to be created when you are eliminating the transaction between the group companies.
Thank you so much, sir. Thank you so much for explaining the question in detail. We have one more question. There is a company which is holding 50% shares in another company, and there is another party which is holding 50% share in the same company. For example, A company is holding 50% share in B company, and C company is also holding 50% share in B company. Then in that case, which company, A or C, needs to prepare the consolidated financial statement? So I think if you can cover this question from AS and Ind AS both perspective. Maybe Achal sir or maybe Paras sir.
So, see, now, first of all, if we talk about this situation from Indian GAAP perspective, so clearly it appears to be a case of joint control. Okay, so the facts are very, very limited. So I won't really say that this is a sort of conclusion, but definitely the control is something which one cannot say will be established immediately looking at only the fact pattern which is available. But looking at the fact pattern which is available, it seems to be a case of a joint control wherein the control is shared by both A and B as around this investee C. Okay, and for which certain requirements are required to be fulfilled, and that is about the establishment of joint control, which says that if the decision making as around this entities, as around the relevant activities of C are required to be taken, then it has to be done on a unanimous basis amongst both A and B. Okay, so once again, if I assume that this criteria is fulfilled, then this could be considered to be a case of joint control. But if at all there are some more facts through which one can establish that A will have unilateral control over B, or B will have unilateral control over C, or there could also be a rare situation under Indian GAAP which is called as dual control. In fact, this is something which happens in a rare scenario under Indian GAAP, and which also happens to be a sort of gap difference between Indian GAAP and Ind AS. See, under Indian GAAP, one can see cases wherein a single entity is consolidated by two investors. So in the given scenario, we may say that A is consolidating C. Why? Because it happens to be a subsidiary, or the one over which the control is established through the majority voting right. I'm assuming it could be through the composition of the board of directors in addition to the percentage shareholding which is available. And B could also be having a control on this entity, which could be through a contractual arrangement or the contractual rights which are available to C. This happens to be a situation of dual control, which is rare under Indian GAAP. But if at all that is there, then this can be consolidated by both the entities, A as well as B. Now, if we move to Ind AS, then I would say the facts are very, very limited. Just by saying that 50% shares are held by A and B, once again, I'll tend to consider this to be a case of a joint control. Why? Because the shareholding is equally spread out amongst A and B, but depending on the facts which are there, this answer may change. If this happens to be a case of a joint control wherein the unanimous decision making is available, then of course A and B will both be consolidating this, though the method of consolidation will be the equity method of accounting as against what we see under Indian GAAP. But if one can establish that A will have control, okay, using various other factors, or B will have control using any various other factors, which has to be amongst A or B only, because under Ind AS it cannot happen that both A and B will have control. It can be available with either A or B, not both. Then definitely it will be a scenario wherein the entity C will become a subsidiary of either A or B. But as I mentioned, that the facts are very, very limited here. Huh?
Right, right. So I absolutely agree. The facts are very limited. For India, of course, as we discussed multiple times, that the control has to be established for any entity to call it as a subsidiary or investor-investee relationship. And from the AS point of view, I think yes. Again, the situation has to be assessed basis what all facts are available, because 50-50%, if that's the case, then yes, as sir mentioned, joint control could be there and both the entities could be consolidating a particular entity. Right, so there is one more question which looks. Yeah, sorry, I'm back. Poor connectivity. So the question is how to consolidate subsidiary if date of acquisition is on different dates. So I think this could be a case of step acquisition where say 10% is acquired once and then 20% is acquired and then 30%, or maybe something like that, or maybe the control was not there first and then the control happened, because that's what I understand from this question, but please feel free to add.
Yes, so this is the case of step acquisition you rightly mentioned. And in this case, when the ultimate control is acquired, then you are required to recognize the assets and liabilities, means you can say the net assets or goodwill or NCI in the consolidated balance sheet. And the former interest, means the interest or the investment which is held by the investor in the investee, needs to be de-recognized in this scenario.
Right. Right. So basically, the accounting will take place in that order. Right.
Yes.
So there is one more question. Accounting in case of assessment of control when there is shareholders agreement. So what I understand from this is they want to understand if there is a shareholders agreement in place, but there are certain other aspects also which may give hints of control by any other party. So will the shareholder agreement overwrite every other aspect, or how will it work?
No, so I don't think so that this shareholder agreement will have some overriding power. I would say that all the aspects will have to be looked at. Shareholders agreement means the terms and conditions which are there in the shareholders agreement, one will have to evaluate that. And if there are facts, if there are any other factors which are sort of different from what is there in the shareholders agreement, those factors. So a combination of all of these factors will have to be evaluated, basis which one will have to assess whether the control is established or not. And as I mentioned, that in case of control, we'll have to look at those three factors. And amongst these factors, the most important factor happens to be the power over the investee, wherein one will have to establish whether the power over the investee is established or not. Yeah, but each and every factor will have to be considered. Huh? So we cannot say that one factor will have some more weightage as against any other factor. No, that is not true.
Right, right. Thank you so much, sir. So now we have a case study which has multiple choice options to answer the question. I think this will summarize the whole discussion in a very efficient manner. So the case study goes like, there's a company, let's call it green company, which owns following investments. So there are multiple investments. So green company holds 80% equity share in violet company, and there is no non-equity shareholding. There is another shareholding by green company, which is a 25% equity share and 80% non-equity share. So let's take, green company holds 80% equity in A company and 25% equity in B company, and also 80% of non-equity in B company, and holds 45% equity share in C company and 25% non-equity in C company. And there is one more fact, that green company has also appointed 5 of the 7 directors of C company. So to summarize the question, there is a main company, green company, and there are 3 different companies, A, B, and C. Green company holds 80% in A, 25% equity in B, and 80% non-equity in B, and 45% equity in C and 25% non-equity in C. Right? And in C, green company has appointed 5 of the 7 directors. So now the question is, which of these investments are accounted for as subsidiary from green company's point of view for consolidation?
So in the scenario of C Limited, I would say if the 5 directors out of 7 directors have been appointed by the green company, then yes, you can say the control is there, but you need to evaluate the other facts as well, right? Because the green limited is holding 45% shareholding, right, which is a good amount of shareholding, and out of seven directors, 5 directors have been nominated by it or have been appointed by it. So in C Limited, we can say control is there, but we need to evaluate the other factors as well. Now, in case of A Limited, you said that 80% in equity and 20% in non-equity, right?
There is no non-equity, there is just 80% equity.
So yes, it is a clear-cut case of consolidation, means we can say the Green Limited is controlling the A Limited, right? Now in B Limited, could you please repeat the percentage of holding?
25% of equity and 80% of non-equity.
So what do you mean by non-equity investment in preference shareholders? Preference shareholding?
Yes, preference.
Okay, so if there is 25% equity portion, then we can say this company would become the associate company of the Green Limited, right? And we will not consider the percentage of holding in preference shares. However, to the extent I can recall, there is section 47 subsection 2 of the Companies Act 2013, which talks about the payment of dividend. So if the dividend has not been paid for a period of 2 years, then the preference shareholders will also get the right to cast their vote in the meetings, right? And if this is the scenario, the percentage of the holding will be changed, and in that scenario we will evaluate. If the percentage is more than 50%, then you can say the control is there, but obviously yes, you need to evaluate other facts as well.
Right. Thank you so much, sir. I think sir has correctly mentioned that A and C out of the 3 would be consolidated by green company, and B, in which green company holds 25% equity, would be looked from a significant influence or an associate point of view. Right. Just to reiterate, why green company would consolidate A company? Because it holds more than 50% of the voting shares, which is like it holds 80% equity holding, which is more than 50%, which gives a very a clear and visible evidence that there would be control. But if there are certain other factors which are not available in the case study, would have to be looked at. But just by this information, 80% shareholding would give a control right. Right. from B company point of view, which holds 25% of equity and 80% of non-equity. So it is important to look at the equity shareholding, as sir has mentioned, as despite having the majority of non-equity shares, the non-equity share do not give the voting power, right?
Right.
But in case there is some other arrangement which allows them to exercise voting power through those
Right. So
shares.
if there is default in the repayment of dividend, or the company has not repaid dividend to preference shareholders for 2 years, then the
Hmm.
preference shareholders will also get the right to cast their vote.
Exactly. So in that case, there will be a clear cut voting power by the B company, by the green company, and there will be a consolidation. In case of C company, which in which green company has 45% of equity shares and 25% of non-equity. So by looking at the percentage of equity shares, you may incorrectly conclude that the green company is not, the C company is not a subsidiary, as green company has less than half of the voting rights. However, by looking at the fact that green company has appointed 5 of the 7 directors, as Paras sir also mentioned, this is, I think, one of the key factor
Criteria.
to
Right.
consider, right, to establish whether green company controls C or not. So in this case, I think the C company is rightfully controlled by green company, and it will be consolidated.
Right.
Right. So to conclude, A and C will be consolidated by green company. Right. So I think those were the questions that we had. Now, if there are any more live questions or anything anyone wants to discuss, Shalini ma'am, I think we have covered all the live questions. But if there is anything that I may have missed out, maybe you can just add. Okay, I think we do not have any more live questions in place right now, and we have covered all the questions. Um, right, we have got the thumbs up from Shalini ma'am. Okay, just hold on. There is one question. Uh, in case a subsidiary company gets audited and the auditors qualify the IFC report of the subsidiary company, then in that case, will the holding company's audit report will get affected or not?
So I would say this is more from an audit perspective rather than an accounting perspective, but it appears to be a case wherein we are just talking about the impact of the qualification of one of the group companies on the group financial statements. And when I say the group financial statements, we are talking about the consolidated financial statements. Now, in this case, I would say two things are required to be evaluated from the auditor's perspective. One, that is to check whether this sort of deficiency which was there, or I would say the qualification, the factors which were there to qualify in respect of subsidiary company, were those significant enough that this will have an impact on the group as a whole rather than only that subsidiary. If the impact is so significant, then definitely this will also be considered by the auditor to include a modification in the audited financial statements of the group. Second aspect could be around the qualification which is there in respect of the subsidiary and which is audited by some other auditor. Okay, because in case of group audit, one of the entity, maybe the parent company, is audited by say ABC, and the subsidiary company could be audited by say XYZ, and wherein the sharing of the responsibility is not there. Okay, so under the Indian scenario, as against ISA, under SAs, we do not have this concept of sharing of responsibility, wherein the qualifications which are given by the component auditor. Component auditor will be the auditor of the subsidiary company, are sort of moved as it is by the parent auditor or the group auditor in the audit report of the consolidated financial statements, which are just carried forward as it is. So both these factors one has to look at, and accordingly the position has to be taken as far as the audit report of group financial statements is concerned.
Right. Thank you so much, sir, for adding this from the auditing point of view, because I think, sorry, uh, yeah, because I think all our professionals are keen to know about the audit impact of all these questions. So thank you so much. I think we will now close the session because we have answered all the questions. And thank you so much to Achal sir and Paras sir for addressing to all the questions in so much detail. And we are grateful to have your knowledge here. And to all the participants, thank you so much for joining. And I'm sure this session was really, really informative and useful to everyone. And thanks to ASB for organizing this session, respected chairman sir and Shalini ma'am and the entire team of the board for organizing this session. I think the topic was really, really important for our times. And thank you so much for everyone to join this session. Thank you.
Thanks everyone.
Thanks so much.
Bye bye.